Hey everybody, Boris speaking at Forex. Welcome to the weekly technicals for the commodity dollars for Aussie dollar, dollar CAD, and Kiwi dollar, April 22nd to April 26th, 2019. The story in the COM dollar land has pretty much been the same, although we do have probably the most important event risk that's going to be hitting the COM dollars on the CAD side, and that should be addressed, which I'll do in just a second as far as trading goes. But when you're looking at Aussie, it's still a 71.72 trade. You're looking at CAD for now, it's a 33.34 trade, although we could really change that as the week progresses. And Kiwi, clearly the weakest link in the chain here, starting to pull away and actually threatening to test some very, very key support levels at the 66.50 level. Not much on the plate as far as event risk goes. Let's take a look at the calendar for most of them. You have CPI from Australia. Now, this is actually could have a meaningful impact because we had mildly okay jobs data, but still a very, very neutral to dovish RBA, I would say. And if you have weak CPI, that only puts the RBA in a greater position to be able to consider a rate cut as you go forward. So I think the slant to the Aussie, and certainly when you take a look at the technicals as well, is that it's probably more to the downside than it is to the upside. Now, CPI comes in first. PPI comes in second, so it's actually going to be more meaningful because, of course, CPI data is always much more meaningful than PPI data. So we'll be watching that very carefully to see how that hits on Tuesday. Then the really big event, well, before I get to that, we have the Kiwi trade balance data. That's Kathy is convincingly bearish. She's confident bearish on this one, so they could really pressure the Kiwi more to the downside. We saw, by the way, the Kiwi CPI data be very, very cool. So very likely we might have Aussie CPI data be cool as well. But the really big event will be the Bank of Canada rate decision because that's sort of the really key marker here of the thinking of the Bank of Canada going forward into the second half of this year. Canadian data has actually been surprisingly strong. And on top of that, oil has been at 63, 64 for the last month and a half. That's very, very supportive of the Canadian economy, even though it's no longer a pure oil-based economy. But it'll be interesting to see just how dovish the BOC will be. I think they're still very, very wary, especially given the fact that their neighbors to the south are very neutral. And I don't think they're going to sort of front run the Fed as far as their position goes, but they could always surprise. I mean, there have been cases in the past where the Bank of Canada has been more hawkish than the market thought. That could really lead to a break of that 33, 34 level that we've been trading in. On the other hand, if they're super dovish and if they basically communicate to the market that they don't really see any potential for further rate hikes this year, given the slowdown across the global economy and the tensions on trade and everything else, and so on and so forth, that could really push us right through that key 34 level. Now, looking at the charts here, let's actually start with dollar Canada. Dollar Canada has been in this very, very tight low volatility range for about a month. We've been talking about 33, 34 really since, when is this? Since the beginning of the month, right? We're almost at the end of the month. We literally have been in a 100-point range. I mean, it's just astounding when you think about how little volatility we've had in the FX market. We've had 100-point days, many, many times. So we've had 200-point days. And here we haven't had a 100-point month. We've literally been just, buy the top, sell the bottom. It's been a fade trader's dream and a trend trader's nightmare. This kind of a very choppy, slow market, up and down. I think, what did we change? 1, 2, 3, 4, 5, like 6 changes across the moving average. A true sign of a pure chop market. But chop does not last. Always. There's always, after chop, there's always some sort of resolution. The critical question is which way. Looking at the technicals right now, the resolution is hinting towards the upside, that the BOC may be actually a little bit more dovish. The reason why it's hinting is because we have a series of higher lows here for the last 3 days. The market seems to be positioning for an upside break. Of course, it can always be shocked and surprised, but if you sort of take a clue from where the positioning is, then it looks like maybe we're going to go to the upside, meaning that dollar CAD is going to weaken as we go forward. Aussie certainly is weakening. And this is interesting. The Aussie weakening here is much more pronounced because what you're looking at is a third or fourth failure at the 72 level and a pretty significant failure. This is really a reversal off of a pretty decent employment data. Couldn't really hold it, came back down, and the fact that we're now below the 50s suggested that the market, especially if we get a weak CPI really puts us square down into that 71 zone to take it all the way down through the 71 level. And I think that's very feasible here. Now, having said that, though, we're still going to find quite a lot of support at the 71 unless the market at this point really becomes convinced. And I think when you're reading a lot of Australian analysis, when you're reading all the West Bank and all of the other Australian bank analysis, they are utterly convinced. The local analysts are utterly convinced that the RBA is going to cut 2 times. If they are even remotely correct, this is going to be below 70 as we go forward. I mean, this could be the beginning of the turn to the downside. Certainly, you have technically lots and lots of evidence here of continued failure. We just need a push. The most immediate push is to the 71, but I think if we take out the 71s, the 70 is going to come in very much quicker than people realize as the market suddenly just turns super dovish Aussie and starts to sell it hard. We've already seen the market turn pretty dovish Kiwi because the RBNZ has been much less sort of communicating the same sort of idea that they're much more open to a rate cut than they are to a rate hike. CPI data came in very soft. All of this tested the 6650 level, 6660 level. This is now takes us all the way down to that fat finger spike low, which is 6585, basically the 66 level. That could be the potential test as we go down as the rest of the week. We're pulling away from the moving average. There's a lot of deceleration. This is a sort of a very similar chart to cable. The technicals are communicating to us the momentum is to the downside, and this is not a time to buy the falling knife on the Kiwi. So that's kind of how the market shapes up. The market is positioning negative calm dollars. We'll see if it's going to be the follow-through week where CAD takes out 34s, Aussie takes out 71s to the downside, and Kiwi takes the 6650 and perhaps even eyes the 6600 as everybody gets much more dovish going forward. Wish you guys the best luck, the best trading. Boris, over now.